So you had some numbers, right? That every time you search something on Google or you search something on ChatGPT, this X amount of power is.
So with Google, it is at 0.3 watt hours
Okay.
per query, and on ChatGPT is currently at 2.9.
So you switch off the lights and use ChatGPT. All right. Hello and welcome to yet another episode of Taking Stock. This is a weekly podcast where every week we pick one company, one stock and deep dive into it. Today we're talking about TD Power, a Bangalore-based generator manufacturing company that's been making a lot of waves in the news. And the first thing that I want to start talking about over here is, and I think there is no debating this, right? That AI consumption across the world for literally from everything small to big has massively spiked. Right. And from what I understand here now is that every time you search something or every time you use AI for anything, there is a power consumption associated with it. Right. So every time we search something on ChatGPT, we're using power. Right. How does that work?
So effectively, I mean, you're running a query.
Correct.
It's passing through multiple nodes or whatever.
Right.
Primarily, it's being analyzed somewhere.
Right.
And a response is being sent.
Right.
Right. Now that AI model is giving you a response, but that AI model has to be trained as well. So there's a training and then there is a usage. So at both places, power is used. And of course, like any other system, in the beginning, in nascency, power usage is going to be very high. And then eventually with scale, economies of scale will be achieved. And then efficiency will also improve because the system will evolve and develop. And power consumption per unit will come down.
So you had some numbers, right? That every time you search something on Google or you search something on ChatGPT, this X amount of power is.
So with Google, it is at 0.3 watt hours per query. And on ChatGPT is currently at 2.9.
So you switch off the lights and use ChatGPT.
So lame.
Okay, go on.
So essentially, these models are using about roughly 10 times more.
Right, and I'm assuming with the scale at which AI is being used across the globe, these numbers eventually add up to be massive numbers.
Not really, to be honest, because at this point in time, if I look at globally, it's roughly between 2 and 4% of total 2 and 4% of total usage of power will
across
be towards across the world will be towards data centers.
Okay.
And within data centers now, there are multiple use cases where computing is about 50 to 60%, cooling systems is 35 to 40%, and then supporting infra is 5 to 10%.
Right.
So within data centers also, AI is roughly about 15%.
Okay.
So 2 to 4% is data centers.
But this is only going to keep increasing.
This will keep increasing. So the thing to remember also here is that power usage on a unit level will keep coming down.
Right.
Because it will match up at some point to 0.3. In fact, Gemini is already talking about it being close to 0.3.
Right.
As systems improve and scale gets achieved, this will keep reducing. But there is a very interesting theory which is called the Jevons paradox.
Okay.
So basically it says that...
Whose paradox?
Jevon.
Who's Jevon?
So dude.
Okay.
So now there's no rabbit holing in this. So basically AI, as it becomes more efficient, he talks about it normally, we're just drawing a parallel to AI.
Okay.
Saying that as and when efficiency of something increases, and because there is a cost reduction, the total usage of it will also increase.
Right.
So one, it becomes cheaper, so people start using it.
Right.
Number two, what also happens is it unlocks new use cases when efficiency improves.
Correct.
And hence people will increase
Fair enough.
So overall, because of both of these things and because of say higher speed, for example, the total power demand will keep increasing even if unit cost keeps reducing.
Understood. Because just overall usage and more use cases and everything is just growing.
Yeah.
So how does power consumption, because we're obviously talking about TD power over here, and there's a massive correlation between power consumption and TD power as a company, right? So with the growth of AI, now we're talking about more, and correct me if I'm wrong, right? We're talking about more data centers that are going to keep opening. And when more data centers open, when things become more efficient, overall usage of AI keeps increasing. And that's when the power consumption is going to sort of, it's a never-ending loop, is what I'm assuming, right?
Yeah. So see, I'll just give you some context here where, for example, you take examples of US and Europe because that's where most of these data centers are.
Right.
And that's where most of the AI development is happening, right? So if I look at the power demand in US over the last 10 years, it's been flat.
Okay.
Despite demand, so despite manufacturing shifting to the US, despite tech evolution happening, etc., etc. Despite demand increasing, power usage has been flat because efficiency also improves at the same time. So effectively, from 2000, say, uh, whatever, 15 to 19, data center workloads have gone up 3x, but US power demand flat. Europe, in fact, has been on a downward spiral. So if I look at the last decade for Europe, power consumption has actually reduced by, or demand has reduced by 10% overall.
Okay.
Not every year.
Right.
Overall demand has reduced by 10%. Now, what we're talking about in this context is that if AI usage increases and hence data centers increase, and the power consumption at data centers increases as a proportion of total in the entire pie, we're looking at effectively 2.4% CAGR in power growth in the US in the future.
Okay.
Yeah, from 2022 to 2030, you're looking at a 2.4% CAGR increase, 40% of which can be attributed to data centers.
Understood.
So it's not a big number, right? When you say 2.4%,
Right.
or when it comes to Europe, the prediction is that 3 to 4% will be the CAGR over the next 10 years. These are not large numbers. But the context is that demand has been flat or negative historically.
Right.
And now you're seeing growth. And if you even sum up, because these are CAGR numbers, in 8 years, you're looking at power growth in US increasing by 20%. In 10 years for Europe, you're seeing power growth forecasted to increase by 40%.
Right.
So these are very large numbers compared to what has happened in the last
happening historically,
3 to 5 years or 10 years.
So so this is pretty much established, right? That this is going to happen, and I don't think there's much to debate about this.
Yeah.
But who sort of ends up benefiting from this? Which companies or sectors?
So the AI guys, obviously.
Right.
That's the first level impact. You know that famous saying of like Levi's when they found gold.
Levi's, the jeans company.
Yeah.
Okay.
So basically in the US, there was a lot of gold found.
Right.
And then they said that it's not only the gold companies that will make money, but also the companies that make shovels. Also the guys.
Right.
Also the
entire ecosystem.
Yeah. So Levi's jeans was like a product of that, where these people were wearing jeans in
Right.
That stock the company did really well as a product.
Right.
So it's similar where like you're not only betting on AI companies doing really well, you're also betting on whoever is setting up the data centers. And these data centers are massive, so they also require captive power. So whoever is also setting up power is going to benefit from it. And that's where finally let's make the connection between this and TD Power, where if you're setting up a power plant for a data center, the most efficient way of doing so, if you're setting up a 100 to 150 megawatt power plant, roughly that's the size required, it has to be gas driven.
Okay. What does that mean?
So it can be, you can fuel it using diesel, for example.
Right.
Not viable because how much diesel can you use?
Right.
You can use it, you can do it using renewables, maybe like solar.
Right.
But data centers require 24-hour power.
So it's not sustainable.
Uninterrupted.
Right. Yeah.
So it is not sustainable because weather, climate, day, night, whatever. And usually data centers not only use primary power, but they also set up a backup source. So it is very, very crucial and critical for them.
Right.
So in that case, what happens is that natural gas becomes the number one contender when it comes to setting up of these power plants.
Right.
So the ones to benefit hence are any manufacturing components that go into the setting up of gas powered plants.
Understood. So anybody sort of involved in the infrastructure of building a power plant is going to benefit from this surge in demand.
Yeah, and especially gas-based ones.
Right.
And within gas-based ones now, if we have to again boil down to where TD Power stands in this entire ecosystem, when you're setting up a power plant, typically what is happening is there is a process which I can or cannot explain, you tell me. But basically natural gas is being used, and then there is several components in the middle.
Okay.
I'll just explain it.
Okay. Go on.
So basically, there is something known as a compressor. Right. The compressor usually takes a large volume of air, compresses it into a small portion. Right. That air is being pushed into something known as a combustion chamber.
Okay.
Now, in that, air and natural gas is used as a fuel.
Right.
In order to create ignition or combustion. Right. Now that combustion, hot gas usually expands in that and it moves a turbine.
Correct.
Right? Turbines blades move or spin. And then what that eventually does is there's a generator which has shafts.
Okay.
So the shafts of the generator will also move,
Right.
and electricity will be generated.
Understood.
So there is a compressor, there's a combustion chamber, there is
Turbine,
a
generator, and
turbine,
electricity.
then there is a generator. These are the four broad
Right.
components.
Right.
In this, TD Power makes the generators.
Understood. And they exclusively only make generators, not any other.
No. So
Parts
there
of
are
the-
separate companies for air compressors or gas compressors. There are separate companies for that.
Right.
Then there is companies which make turbines. Then there are companies which make generators.
Right.
So this one is a generator manufacturer. Usually, turbine companies also make generators.
Understood.
So when we look at the gas market, for example, the gas turbine market, GE, Siemens, and Mitsubishi are the three largest players when it comes to
Right.
large-sized gas turbines. Now, as the size and complexity of this grows, they usually provide it as a solution. You can't just say that, oh, GE, give me a turbine.
Correct.
Then you'll call TD Power, hey, give me a compressor, generator. It doesn't work like that.
Right.
You can't just order these things
Correct.
manually as a factory owner and say that I will assemble it.
Right.
It's not IKEA.
Of course, yeah. Exactly.
Like you don't have an urban company.
Yeah.
Right? So these are very complex things.
Right.
And the generator, the compressor, they have to fit to the exact requirements of the turbine. So typically, turbine manufacturers, they provide a solution saying that we'll fit the entire thing.
Right.
In that, the compressors mostly will be manufactured by them. In some cases, they're also manufactured by or outsourced.
You mean the generators?
Sorry, generators. Sorry.
Yeah.
So the generators would either be manufactured by them or be outsourced by them to players who specifically make generators.
Understood.
Like
TD Power. Okay.
Yeah.
So basically now, essentially what ends up happening over here is, so so basically these turbine companies, so TD Power is sort of working very closely as a generator manufacturer, but working very closely with the turbine companies to meet their demand.
Yeah.
Right. Yeah. And that's the sort of infrastructure setup. Right.
So they will be majorly supplying to OEMs. That's number one. And by OEMs, I mean people who are manufacturing these turbines or generators. Or they will be massively also supplying to some turnkey project developers or EPC guys,
right?
Who are basically taking on a project and saying, I will give this power plant to you. I will manage everything. The entire project, right from designing, procurement of materials, construction, and aftermarket services is managed by one company.
Understood.
So that will be the customer for TD Power.
So now this is something again I read, right, where it's sort of in the news, or it's always sort of been the case where there is a shortage of turbines. Now, when from what I understand, again, you'll probably know this better, but it's not as much as there is a shortage of turbines, but there will always be a sort of a little bit of a gap between the number of turbines that exist and the amount of demand that's up there, right? And that's sort of always been the case and always will be the case.
That's not always been the case. I think there was a time when maybe even supply was exceeding demand.
Right.
Because all of these, demand has always been healthy. And then these guys went a little overboard, installed a lot of capacity. Also because the setting up cost came down. After that, suddenly prices also came down and these guys ended up suffering. So now they've taken a more prudent approach.
Right.
So Siemens, Mitsubishi and GE have sort of, I mean, they're following the same strategy, but they're being a lot more prudent about capital allocation. Because making of turbines is not an easy process.
Of course.
To even deliver one unit, it sometimes requires 2 to 3 years of construction in order to deliver one unit.
Right.
So these guys are operating on multiple turbines with very different specifications at all given points in time and different capacities.
Right.
So it's very, very hard to set up capacity and stuff like that. And hence these guys are being very careful about it. So what's happening is that you're right. There is a boost in demand. So if I have to just take one step above and look at where the gas turbines are being used. And I'm talking only about gas turbines. Right. So 50% of it is used in electricity manufacturing, electricity or power and utilities. Right. So AI data centers and a lot of transition from coal to gas is happening. So while power demand has not increased in the US, when I say that, there is an underlying shift in the source of power.
Correct.
So coal being abandoned for gas, for example, that's happening in Europe in a massive way as well. So electricity makes up for about 50% of the total demand for gas turbines. 40 to 45% is oil and gas sector, and then 5 to 10% is aviation, where jets, for example, use turbines. So there is demand increase happening across the three regions: oil and gas, electricity, as well as aviation. And supply is being constrained because capital cost is going up. History has not been too favorable. Raw material cost is going up. And there is uncertainty about AI demand because there is a lot of hype right now and it is reflecting in numbers. But is it going to
be just a fad, or is it here to stay?
It's hard to predict the trajectory because is it going to be further accelerating? Will it flat out? Will it? We don't know. Nobody knows. So to set up turbine capacity is difficult for these days.
So let's probably zoom out a little bit from this, right? Now, firstly, like if you can tell everybody a little bit about TD Power as a company, and then how does this entire whatever the situation is across this entire ecosystem, whatever we've spoken about, how does TD Power actually end up benefiting from this all?
So what's essentially happening is that because there is a supply crunch, the waiting period is very long.
Okay.
So now there is, in some cases, even 5 years of a waiting period where you place an order right now and the company is saying we'll deliver after 5 years.
Right.
So that's the situation. Now what is happening is in that process, these are guys who are, even if there's no shortage in terms of compressors or generators. The shortage on turbines.
The turbines is one part of the
bottleneck
thing.
Is not this.
Right.
So we're not really saying that there is a shortage of generators, but the supply of generators is going to ultimately depend on the supply of turbines.
Turbines, correct.
Right. So eventually what is happening is there is healthy demand in the industry. Bottleneck is somewhere else. But when it comes to TD Power now, these guys are able to take the load off the OEMs in some cases when they say that we'll make the generators. So that's one part. Visibility is very high when it comes to supplying to these OEMs in that category where there is a shortage. That is obvious. When demand is exceeding supply, you're in a good place. Right. So that's one driver for TD Power. The second driver for TD Power is what's happening because of a shortage in the large turbine space is that data centers usually can do with smaller generation capacities. So if I have to again take a little bit of a step back into how the entire industry is placed, there is something known as heavy frame, which is greater than 225 megawatt capacity.
Okay.
Then there is a medium which is called an aero derivative, which is 25 to 100 megawatt. And then there is a light industrial, which is 1 to 50 megawatt.
Right.
In this, what is happening is in the heavy frame turbines, the top three players which I mentioned have a 90% share. Right. Now, in the aero derivative ones, GE is at about 60 to 90%. Both of these segments have a shortage.
Okay.
What is happening now is that a lot of data centers are setting up smaller capacities.
Right.
Saying that if there is a shortage in the larger ones, we can't wait 5 years, we have to set up right now. We'll break it down into two and do it right now. Or we will set up multiple plants and do it that way. Because anyway, the second part is where most of the data center demand was.
Correct.
It's just shifting to the third.
To the third part, right?
So in this, the equation is a little more different. So it is not the top three making up for 90% of the demand. It is actually Solar Turbines, which is the largest, along with GE. Solar is someone which is funded by Caterpillar.
Right.
So that is 22%, 25% market share. GE is 25. Siemens, Kawasaki, Man Energy.
Right.
These are the ones in that particular segment. Now, the game changes here because TD Power does not really have to depend on the heavy frame ones in order for the supply to happen after 5 years or whatever. There's a lot of demand happening in the light industrial turbines, and that's where there is a large spike. So TD Power hence is benefiting from that change.
Right. Makes sense.
That's the second driver for TD Power.
Okay, so based on everything that you've explained now, I think one simple conclusion that I can draw here is that TD Power is currently on a good footing, right? It's in a good space. What does it look like from a financials and numbers point of view? Where do you see TD Power in the next few years, in the near future?
Okay, so I think it's also important to give a little bit of a context here in terms of TD Power, because we've primarily had the conversation revolve around gas turbines and data centers so far. However, if you look at TD Power, it is not only gas generators that they make. So they make steam generators also. They make hydro generators. they make gas engine generators and gas turbine generators.
Okay.
So within generators, they have 4 different types of generators, not four, broadly classified 4 generators that they're making. And then they're making other stuff as well. So they're making motors, then they're doing aftermarket services and stuff like that. Now, if I sort of go back to like the commentary, management commentary, or the numbers of TD Power, what they're seeing is that steam generators are growing at a steady 10 to 12%. They have historically grown at that rate, and they're continuing to grow at that rate. What is seeing very good growth is gas, because of data centers and because of oil and gas, and hydro generators, because hydro power generation is also pretty much a very large focus around the globe. And wherever these guys do that kind of power generation, TD is sort of present in terms of providing the generators. So it's a function of 4 different moving parts and not just one.
Right.
But safe to say that they're seeing very, very high demand in the gas generators bit. It is reflecting what we've spoken about in terms of demand supply shortage and very heavy demand, etc. is reflecting in their commentary. They've actually, in fact, increased their guidance. They're focusing a lot on data centers within gas turbines. And that is also reflected in their order book. So their order book, in fact, if I kind of look at, it is currently at about 1,587 crore.
Okay, and this is for the next?
So that depends on the period, because it's also a mix of different
right. But this is basically sort of confirmed on the order book, which is what they've announced.
So this is the orders they have at this point in time. It was about 1,587 crores. Just to contextualize this number, in FY25, they did revenue of 1,280 crore.
Right.
So this is roughly 1.25x of the revenue itself, the annual revenue itself. So this sort of gives you visibility of growth in the future. What also has happened is, as a function of this order book, is that and this order book number is actually increasing on a quarter-on-quarter basis. So sequentially, they're actually doing much better compared to what was the number previously. So if I have to, for example, look at the second quarter of FY26, their order book has actually grown by 45% year on year. So this is a massive, massive growth.
Right. And
60% of it is export driven.
Right.
Pure play export driven, which is again, it's going.
And essentially, the market dynamics sort of stayed, unless obviously there's some major changes. The market dynamics sort of state that this is going to continue. This is a trend that is going to continue, at least in the near future, where the order book is going to increase quarter on quarter.
Yeah. So we don't know if it will accelerate from here in terms of the number.
Right.
Whether that 45% will become 50%, why 60%, that we don't know. But at least momentum wise, there is enough happening at this point. Like second degree, I don't know. Like velocity is the acceleration.
Right.
So that is something that's a question. But in any case, I mean, the fact that it's growing at 45% YOY is evidence enough that this company is doing really well. And in fact, the company also gives a guidance. So while they have visibility of the order book, what they're also saying that for FY26, they will do a minimum of, no, not minimum, they'll do a 1,800 crore revenue in FY26.
Okay.
So just to again,
which is again about a 30% odd increase.
Wow, you're really good at maths here.
Yeah, of course. I'm AI.
So FY25, the revenue number was 1,279 crore.
Right.
They're saying they'll get to 1,800 crore in FY26, and they'll do at least 2,000 crore in FY27.
Right.
Now, you're not supposed to, FY27, if they're saying 2,000, that's just 10-15% growth. And they were asked this in the commentary, management call. And they were like, hey, what we're saying is that minimum we'll do 2,000. So that means we'll do about 2,000, 2,200 at the least. So they're just throwing 200 crore number around like that, right? Like, 2,000, 2,200. So what they're also saying is that they're increasing capacity. And one of the third plant that they're putting up now, they've got 2 already. They're putting up the third one. That's going to get commissioned this quarter, right? Now, with the existing capacity, in terms of machinery, land and buildings, they will be able to easily do about 25 to 2,600 crore of revenue. So clearly, I'm just picking up some qualitative aspects from this in terms of saying that these guys are poised for healthy growth.
Right. The potential is there. Whether they get the orders or no is obviously
I mean, they're already
Yet to be
getting the
seen,
orders.
yeah.
Nobody's going to put in the capacity without having the visibility.
Correct.
And they're already talking about 2,000, 2,200 loosely
Right.
revenue in FY27. So if I have to just sort of put this into growth numbers, what it comes to is about a 25% CAGR over the next 2 years in terms of revenue,
Right.
which would also mean that, I mean, for example, if they do maintain margins or increase them slightly,
Right.
because they're getting into more specialized products which have higher margins, they could, based on their own guidance, see north of 25% CAGR on EBITDA and PAT as well. So you could expect whatever 25% revenue, 30% PAT EBITDA
Right,
CAGRs over the next 2 years. That's the numbers we're looking at.
So where does it stand from a profitability point of view currently? I mean, I know we've spoken about revenue, but how are they poised in terms of their PAT and the profitability, etc.?
So that's been increasing quite steadily.
Right.
Actually, they went through a bit of a rough period between FY12 and FY18.
Right.
And they ended up with FY18 being at a EBITDA margin of 2%. Then they had to take corrective action and stuff like that. And they've now started focusing on their core business all over again. So FY18 to FY21, if I look at, the margins went from 2% to 12%. So the 18 to 21 period is also, I'm sort of marking that because that is a period of stability, gaining stability, regaining focus, realigning operations, finding ground. And from FY21 to FY25 has been a growth period.
Okay.
So from there, margins have sort of gone up from 12% to 18% now. So from 18%, as they focus more on specialized motors or high demand products where anyway demand is exceeding supply and there is a certain amount of margin power they have, you can maybe assume 18% can go north, keeping in mind or assuming raw material costs remain steady, which is a very wild assumption to make, but still. So that's where they are at a profitability standpoint. I also want to sort of just give a shade on profitability from the perspective of return ratios. So these were negative in FY18. They came to about 10-ish% in FY21. And then now north of 20%, 22% ROE, 30% ROCE as of 25.
Right.
So that's been the profitability trajectory.
Fair enough. And what about valuation? The big question as always, right? So where do they stand, or what is your view? Forget where do they stand, but what is your view from a valuation point of view?
So here's the deal, right? Over the last 5 years, the company the stock has given a return of 34x.
Okay.
So if you invested 1 rupee, it would have become 34 rupees.
Right, that's phenomenal in the last 5 years.
So
this is essentially when the growth phase started in 2021 or around the time. Right?
Yeah. So basically they stepped out of their troubles from 12 to 18, between 18 and 21.
Right.
So the market must have seen evidence of them getting out of the woods.
Correct. So the price sort of started going up around 2020-ish.
Usually majority of the re-rating happens once there is some evidence of it happening. Right?
Correct.
So once the evidence came in and the numbers started reflecting that, it's a classic case of what we usually seek for in any given stock is a combination of very strong earnings and very good valuation re-rating.
Right.
So that creates a spiral effect and makes the stock go ballistic.
Correct.
And that's what's happened in this case.
Right.
However, that's already happened.
Correct.
So a lot of people sort of see this stock, they put their parameters on screener and whatever and come up with...
Say that it's already played out. That's the assumption.
That's what we'll say. The layman usually comes to a point where they're like, hey, this company has done excellent numbers over the last 3 years, so this is bound to continue. And what's happened in the past is bound to happen in the future, despite so many disclaimers that past performance is not really indicative of future performance. So just to give context of what can be, if I have to sort of just look at 21 to 25, right, which has been the turnaround period, they've clocked a 21% revenue CAGR. What I basically want to see is, can they continue doing the same thing?
Understood.
Right? So 21% CAGR is what they've clocked. Based on our discussion right now, they can do a 25% over the next 2 years.
Right.
So acceleration.
Correct.
Right? So great. EBITDA CAGR has been 34%.
Okay.
That's also because profitability has come from trouble to better. From here, can they clock 21 to 34, 21 revenue, 34 EBITDA?
Right.
Can they do 25 revenue, much higher EBITDA? Probably not.
Right.
Right? Because now you've already achieved
Correct. To continue that is very
so
tricky.
it's going to be difficult. So PAT CAGR from 21 to 25 was 40%.
Right.
Can they continue 40%? Probably not.
Huh.
So in that case, can the valuations re-rate further from here?
Right.
Becomes a little difficult if the valuations are already high. So if I have to look at the valuations again, if I have to just look at TTM numbers, I hate to do that, but I will also give you some context. Trailing 12 months, PE is 73 times.
Okay.
I'm not going to pay too much attention to that number because you're investing for the future. If I have to assume that there is 30% PAT CAGR in the next 2 years, we are looking at a 43 times PE 2 years forward.
Right.
For 30% growth, 43 times PE. I think it's already valuations are incurring or factoring or reflecting a lot of the growth.
Right.
So from here, there has to be a beat in earnings, or this company has to exceed
CAGR expectations.
It has to outsize it or beat it in order for the market to say that, boss, this is not worth 43 times, this is worth 50 times.
Correct.
So I would look at a couple of things here. Qualitatively, I would look at how much AI as a percentage is forming as a percentage of total revenue and total order book,
right,
and hence driving how much growth. And number two, from 25%, am I seeing an uptick in terms of either revenue and or margins because of either demand supply mismatches or because of whatever factors. So if I see evidence or if I see progress on any of these two metrics, I would probably consider that there is an upside on valuations as well. Otherwise, not really.
But how does this compare with the other players in the industry?
I think it's pointless to compare that in any case, because the comparables are either equipment manufacturers which are bracketed into one small piece. There's no direct compressor.
Right.
I can compare it to someone who's making turbines, but those guys are making turbines for steam and not for gas.
Understood.
So it's again pointless.
So it's not a real direct comparison.
So yeah, I would be much more comfortable comparing it to its own historical financials and the trajectory going forward, rather than pegging it to somebody else, which is a loose comparison.
Fair enough. So I think, yeah, it's quite clear that so essentially,
so the story has played out,
but you have to sort of look at a few qualitative factors. And is there?
I would look at just one quantitative, one qualitative factor in order to figure out whether from here also on expensive valuations, whether there is more upside on valuations or not.
Right. And the AI aspect plays a huge part in.
That's what. So qualitatively AI, quantitatively order book and revenue and profit growth.
Right. Fair enough. Sounds good. Okay. So let's go to the community question of the week. Community question, for context for everybody, is basically every week from all the questions that we get on our socials, we pick one question and we get Sagar to answer that. This week we've got Shivansh Honarao from Baroda, who's asking Asian Paints. Okay, so he's asking essentially what he's asking is, Asian Paints is a great business and a market leader in its industry, but its stock isn't doing too well. What do you think is the reason behind it? So essentially the question here is, what's the difference between a good business and a good stock?
Yeah, there is a difference, which a lot of people don't understand, that good companies.
Right.
I wouldn't say, so there's a difference between a good company, a good business and a good stock.
Okay.
And Asian Paint is a great company.
Right.
But what's happened in the recent past is there is a lot of new players and new entrants which have come into the paints industry.
Right.
Including very deep pocket ones like Jindal and Birla. So Asian Paints, and they've captured market share aggressively.
Right.
So Asian Paints was historically in a position where it was the highest market share. It had a very beautiful positioning where it commanded a pricing premium from users and lower margins given or commissions given to distributors.
Right.
Because there's so much.
So it was winning on both ends, essentially.
Winning on both ends. And a lot of these players obviously saw that this is happening and there is a potential for disruption in the industry. At the end of it, paint is commoditized. How much ever you want to brand it, a red paint is a red paint, and it is chip proof and whatever. So all that technology and whatever. I mean, sure, there is R&D that goes blah, blah, but at the end of it, it's a commodity.
Right.
So these guys put in massive capacity, did a lot of rejigging in terms of advertising and distribution and blah, blah. And the one to lose the highest in such a scenario would be the one with the highest market share.
Right.
So Asian Paints was on the losing end when it came to this, and it obviously had to face pricing pressure also. So all those historical benefits it enjoyed on both ends had to be squeezed.
So as a company, I'm assuming this, right? But as a company, it's still profitable, and obviously it's lost some of its market share.
Yeah.
But as a stock,
So,
so your stock price essentially is based on future prospect.
so to break it down very simply, I would say that the stock price is going to be a function of earnings growth and valuation.
Right.
In terms of earnings growth, it has slowed down because of the entry of these guys. On the valuation front, the premium it commanded historically, no longer it will command because it's not an indisplaceable competitive player any longer.
Right.
And clearly there is evidence of it being little displaced and potential displacement possible.
Understood.
If both of these go down, the stock comes under pressure. So
Fair
it's
enough.
as simple as that. So this is something that will continue till the time either the price becomes very attractive or till the time one of these fundamental factors in terms of competition or intensity change.
Right.
So hence we are where we are.
Makes sense. So hope that answers your question, Shivansh. And for everybody else listening, please write in with your questions and we'll try and answer as many as possible. That's all for this week. So thank you so much. Taking Stock is a weekly podcast and we come up with new episodes every Tuesday. So see you all next week.
Disclaimer. This content is for informational purposes only. None of the stocks, brands or products mentioned are recommendations or endorsements.